All right, class, welcome. We've laid a really solid foundation on the general rules for capital gains. But let's be real, that's the textbook stuff. The place where tax professionals really show their value is in navigating all the exceptions, the special cases. So today, we're diving deep into some of the most important ones. This is where theory meets practice. This explainer was prepared by Samir Al-Rashani, PhD, with AI support. So this is really the big question for today. What happens when capital assets just don't play by the usual rules? We've got our general principles down, but the Tax Act is absolutely packed with these little carve-outs for specific types of property. And trust me, understanding these special rules is what will set you apart in your careers. So here's our roadmap. We're going to start in some familiar territory with financial instruments, then we'll jump into the super relevant modern world of commodities and digital assets. After that, we tackle the big one from most Canadians, real estate. Then we'll get into some pretty sophisticated deferral strategies, and we'll wrap it all up with the key things you absolutely need to take away from this. Okay, first up, financial instruments. I'm talking about the bread and butter of investing for most people. Stocks, mutual funds, that sort of thing. I'm sure many of you already own some, but as you're about to see, the tax treatment can get way more complex than you might think. Let's kick things off with a scenario you're guaranteed to see. Identical properties. So picture this. You've been buying shares of, say, Apple over the last few years. The price was different every time you bought. Now you decide to sell half of your shares. So, what's your cost? Which price do you use? Well, you can't just pick the highest price to get the lowest tax bill. The rules are black and white on this. You must use the weighted average cost method. No exceptions. Let's actually walk through the math here. In our example, we've got 3 different purchases. We end up with 380 shares in total, and we've spent a total of $3,000 to get them. So to find our weighted average cost, it's simple division. $3,000 divided by 380 shares. That gives us our magic number, $7.89 per share. That is now the adjusted cost base, or ACB, for every single share. So when we sell 150 of them, we just multiply 150 by that average cost to find our ACB for the sale, which gives us a capital gain of just over $166. Now let's look at a couple of other interesting cases. On the one hand, you have convertible securities. Think of a bond that lets you convert it into shares of the same company. The tax system actually gives you a bit of a break here. It's called a tax-deferred rollover. Your cost base, your ACB, just rolls over from the bond to the new shares. No tax to pay right now. Options, though, totally different story. If you're the buyer and you use the option, its cost just gets added to what you paid for the property. But if you're the one who wrote or granted the option, you have an immediate capital gain. The timing and the outcome are completely different depending on which side of the transaction you're on. Mutual funds. This is a huge point of confusion for so many new investors. It's really a 2-step process. First, the fund makes distributions to you. Interest, dividends, capital gains it earned. That amount is taxable to you in that year, even if you just automatically reinvest it. That's step 1. Then, step 2, that reinvested amount gets added to your total adjusted cost base. This is super important because it makes sure you don't get taxed on that same money a second time when you eventually sell everything. And this table really brings that point home. Let's say your fund distributes $300, made up of $100 of each type of income. The full $300 is reinvested, so your ACB goes up by $300. But look at what's actually taxable for the year. The $100 of interest is fully taxed. The dividend gets grossed up, so you're taxed on $138. The capital gain only has a 50% inclusion rate, so even though your investment cost went up by $300, your actual taxable income from this distribution is $288. It's a really critical distinction to understand. Okay, let's switch gears and talk about something a little more modern, commodities and digital assets. With these, the central question we have to ask is fundamental. Is it a capital gain or is it business income? Because that answer changes everything about how it gets taxed. Now, typically, commodities aren't seen as capital property. But here's a weird quirk. The CRA has an administrative policy that actually gives taxpayers a choice. You can choose to report your gains and losses from commodity speculation as either capital or business income. That's a lot of flexibility. What's the catch? You have to be consistent. Once you choose a method, you're stuck with it. And there's a big exception. If your main business is tied to that commodity, like a farmer trading wheat futures, you don't get a choice. For them, it's always considered business income. So, how does the CRA look at cryptocurrency? Well, their position is clear. For tax purposes, crypto is a commodity. It is not currency. And that distinction is everything. It means anytime you get rid of it, it's a taxable event. We call that a disposition. So selling it for Canadian dollars, trading it for another crypto, or even using it to buy a pizza, that's a disposition. And you have to calculate your gain or loss right then and there. All right, time to move on to our third section, real estate. And this is a huge one. For most Canadians, their home is their single biggest asset. This makes understanding the principal residence exemption probably the single most important tax provision they will ever use. So, what exactly makes a home a principal residence? Well, there are two big tests. First, pretty obvious, you have to own it. Second, you have to ordinarily inhabit it. Now, that phrase is intentionally a bit vague. It doesn't mean you have to live there every single day of the year, but it has to be a place you use personally. And remember, a principal residence is a type of personal use property, which means gains are taxable, but any losses are not deductible. You can't claim a loss on the sale of your home. Now, this formula might look a little intimidating, but it's the key that unlocks a massive tax break. It's designed to reduce or even eliminate your capital gain. You just take your total gain and you multiply it by a fraction. On top, you have 1 plus the number of years you're calling it your principal residence. On the bottom, you have the total years you owned it. If you designate it for every single year you own the place, that fraction becomes 1 or more, and poof, the entire capital gain disappears. Now, let's talk about the fine print, because it's really important. That little +1 in the formula, that's what we call the 1+ rule. It's there to help you out in a year where you sell one home and buy another, so you can effectively get the exemption on both for that one overlapping year. But here are the big limitations. You can only designate one property as your principal residence for any given year. And that rule applies to your entire family unit, you and your spouse or partner. You can't have one spouse claim the house and the other claim the cottage for the same year. One per family per year. That's it. Let's dive into our fourth section on advanced deferral strategies. The key word here is deferral. We are not talking about an exemption where the tax goes away forever. These are powerful tools that let you legally push the tax on a capital gain into the future, which is a massive part of smart tax planning. So here's how the general replacement property rules work. It starts with a disposition. That could be you selling an asset, or it could be involuntary. Maybe a building burns down. The next step is you take the proceeds you receive and reinvest them in a similar property within a certain time limit. If you do that, the capital gain you would have had to pay gets deferred. And here's how it works mechanically. That deferred gain reduces the ACB of your new property. So you're not getting out of the tax, you're just kicking the can down the road until you sell the new property. Now, here's a really interesting deferral that's designed to do one thing: encourage people to put money into Canadian small businesses. The rule says if you have a gain from selling shares in one small business, you can defer paying tax on it if you reinvest that money into another eligible small business. But here's the crucial part. You have to buy newly issued shares directly from the company. This ensures that your money is actually helping that business grow, not just buying shares from another investor. Let's put some numbers to that. Say you sell shares for $1 million. Your cost was $400,000, so you have a $600,000 capital gain. Now, you take $900,000 of your proceeds and reinvest it. The amount of gain you can defer is proportional. Since you reinvested 90% of the proceeds, you get to defer 90% of the gain. So you defer $540,000. That means you only have to recognize a $60,000 gain this year. And, just like before, that deferred gain of $540,000 lowers the ACB of your new investment. Okay, this rule is a game changer. It's one of the most powerful tax incentives we have in Canada. If you have stocks or mutual funds that have appreciated a lot, instead of selling them and paying capital gains tax, you can donate them directly to a registered charity. If you do that, your taxable capital gain is zero. It's completely eliminated. And on top of that, you get a donation receipt for the full market value of the shares, which gives you a big tax credit. It is an absolute win-win situation. We have covered a lot of very technical ground today. So for our last section, let's step back and pull it all together. Let's focus on the big concepts and what they really mean in the grand scheme of things. You know, when you boil it all down, these special rules really fall into 3 big buckets. First, we have averaging. That's what we do with identical properties to find a fair cost base. Simple enough. Second, we have deferral, which is all about postponing tax, like we saw with replacement properties and small business investments. And finally, the most powerful of all, we have exemption, which just wipes the tax out completely, like with our homes and charitable donations. So I want to leave you with a final thought to chew on. We've seen all these ways our tax system gives preferential treatment to capital gains, right? Lower tax rates, deferrals, exemptions. So my question for you is, what does that do to our behavior? How does it influence the decisions people and businesses make about where to put their money? Does it push us to take more risks, to invest in growth? And what does that mean for the Canadian economy as a whole? There's no easy answer here, but it's exactly the kind of question you should be thinking about.
Thanks, everyone.